When you're standing on the beach looking out at the ocean, the surface usually looks incredibly peaceful.
Yeah, totally calm.
Right. But underneath that calm facade, there are these massive predators moving terrifying amounts of water around.
Oh, exactly. And in the crypto markets, you rarely get to see the predator until it actually breaches.
Exactly. And today, we are looking at a massive splash. We have data showing a whale just dropped $377 million in Bitcoin onto the Kraken exchange, just completely out of nowhere.
Which is just a staggering amount of capital.
It really is. And it happened right alongside a massive $50 million whale short position being opened. For the 96% of retail traders who eventually lose all their money in this space, a splash like that triggers absolute panic.
Oh, it creates a total wave of chaos. And when the water churns like that, human instinct just sort of takes over.
Yeah.
Suddenly, everyone is just scrambling for the shore without even looking at where they are actually swimming.
Well, welcome to a very special edition of our Deep Dive. This is Bitcoin Deep Dives by MyCryptoParadise. Today, we are stepping directly into the inner circle, analyzing some really high-stakes market insights from our Paradise team professional trader, Simon.
It's going to be a fascinating breakdown.
It is. We are going to decode the mindset of a professional trader navigating these turbulent waters. We're exploring the behavioral science behind why so many people get wiped out, the psychological divide between a gambler and a casino owner, and how you can apply these professional strategies to keep your capital safe and growing.
Yeah, and to understand the psychology of winning, you first have to really understand the mechanics of the battlefield.
Right, the actual numbers.
Exactly. The numbers you just mentioned, the $377 million deposit and the $50 million short, they tell a very specific story about what the market is doing right now. Bitcoin is currently testing a really crucial technical support level.
Okay, so what's happening under the hood there?
Well, beneath the surface price, the internal plumbing of the market is shifting. We are seeing a significant drop in open interest for futures contracts.
Let's break down the mechanics of that for a second, because when we talk about futures long positions closing and open interest dropping, we are basically talking about leveraged bets being wiped off the board.
Yes, exactly.
Traders who borrowed money to bet on the price going up are being forced out, and often at a really big loss.
Yeah, they're taking a massive hit. Usually when leveraged longs are forced to sell like that, it creates a cascading price drop.
Right, a total free fall.
But Simon's data shows something different here. The spot market is actually stepping in. People buying actual unleveraged Bitcoin are absorbing all that selling pressure.
You know, it makes me think of like a heavy-duty sponge soaking up a spilled drink.
That's a great way to look at it.
Yeah, because the futures market is basically recklessly knocking the glass over, creating this messy, volatile sell-off. But the spot market is just sitting there underneath it, silently and systematically absorbing the mess.
They're just soaking it all up.
Right. It isn't flashy, isn't driving the price to the moon instantly, but it's stabilizing the foundation.
The spot buyers are acting as a massive buffer. And Simon uses another excellent physical analogy to explain this current market structure through the lens of Elliott wave analysis.
Oh, the breathing analogy.
Exactly. He describes the market moving in a rhythm of inhales and exhales.
Okay, so an inhale is what exactly?
An inhale is an impulse wave. It's a strong directional move forward. And an exhale is the correction, specifically what is known as an ABC zigzag pattern.
I want to really visualize that ABC zigzag because, that terminology gets thrown around a lot on social media without much context as to why it actually traps so many people.
Well, the mechanics of the ABC zigzag are pure behavioral psychology playing out on a chart.
How so?
So after a big run at the inhale, the market needs to breathe out. The A wave is that initial drop.
Which most retail traders just brush off as a tiny dip, right? They just buy it immediately.
Exactly. They buy the dip, then comes the B wave, which is a small fake-out bounce upward.
Ah, the trap.
Yep. This bounce convinces everyone the bull run is back on, so they over-leverage themselves. And finally, the C wave hits, dropping the floor right out from under them and flushing all that new leverage out of the system.
Wow. Which Simon compares to doing push-ups. When you start, you have all this explosive momentum, right? You're flying through the first 10 reps.
Yeah, you feel unstoppable.
But eventually, your muscles just fatigue. You do one rep, then you pause, you do another, and your arms are shaking. Eventually, you just run out of fuel, and gravity simply takes over.
The market right now is experiencing that exact muscle fatigue. The initial leverage fuel is just gone.
And when momentum slows down in a highly leveraged environment, the market turns into what Simon accurately describes as a predator.
Oh, absolutely.
Yeah?
It starts hunting herds of liquidations. Market makers, the entities providing liquidity, are always looking for areas where the most pain can be inflicted for the highest reward.
I always find the mechanics of a liquidation cascade terrifying, honestly, but also fascinating. Simon points out that there's a target on the upside at $79,741 that would liquidate nearly $12 billion in short positions.
It's a massive pool of liquidity.
Right. So how does that physical mechanism work to actually drive the price?
Well, when a trader opens a short position, they are borrowing Bitcoin to sell it, right? Hoping to buy it back cheaper later.
Right, making a profit on the difference.
But if the price goes up instead of down, their account margin drops. Eventually, the exchange just forcibly steps in, liquidates their account, and automatically buys back that Bitcoin at market price to cover the loan.
Oh, wow. So imagine billions of dollars worth of automatic forced buying happening all at the exact same time.
Exactly. That forced buying drives the price even higher, which triggers the next guy's liquidation price.
Forcing more automatic buying?
Yes. It's a literal domino effect. And conversely, there is a heavy cluster of liquidations waiting to be hunted on the downside at $73,000, where forced selling would trigger a similar downward spiral.
So knowing that this predator is hunting in both directions, I have to ask about those spot buyers acting as the sponge earlier.
Sure.
Simon notes that the big players are defending this current support level. But do they actually expect a massive moonshot to happen right now? Like, if they are buying millions of dollars of Bitcoin here, are they stubbornly holding out for a target like $169,000? Or are they playing a different game entirely?
Oh, they're playing a much more defensive game. The professional mindset does not blindly hold out for a six-figure target during a choppy, exhaling market.
That makes sense.
Simon observes that these big players are incredibly fast to protect their capital. If the price moves slightly above their entry point, they're immediately moving their stop losses up to break even.
Or taking small profits off the table.
Exactly. Their priority is protecting the money they have already risked, rather than holding on to some fantasy of endless, immediate gains.
The contrast there is staggering. The big players are prioritizing risk management and capital preservation to an extreme degree.
Extreme degree, yes.
And that tees up our second segment perfectly, because it highlights exactly why retail traders get absolutely destroyed in these identical market conditions.
It all comes down to a fundamental behavioral trap.
The trap that catches 96% of people. It just blows my mind that so many individuals enter this hyper-competitive space genuinely believing they're going to find a magical secret setup to turn $1,000 into $100,000 in a single week.
Well, you have to look at the environment creating that bias.
Social media.
Mostly, yes. Social media influencers are the engine of this delusion. They constantly sell the illusion of instant wealth.
Right, flashing screenshots of massive percentage gains.
Yeah, while deliberately omitting the statistical probability of ruin, they prey on the human brain's hardwired desire for instant gratification.
Simon uses this incredible casino analogy to break down this divide. He points out that, yes, a gambler absolutely can get lucky. You can walk into a casino, sit at a roulette table, and hit 0 8 times in a row.
It's statistically unlikely, but it happens.
Right. Short-term luck is entirely possible, and it happens every day in crypto. Someone buys a random token with 100x leverage and makes a fortune.
But the distinction lies in the business model. The casino owners do not rely on luck.
No, they don't care at all.
Right. They don't care if a random gambler wins big on a Tuesday because they know the mathematical probabilities are weighted in their favor over thousands of spins.
The edge might be tiny, like just a fraction of a percent.
But over time, that edge guarantees the house wins. Market makers and professional traders act as the casino. They rely on probability, not hope.
You know, if the market makers and the disciplined professionals are the casino owners, then the social media influencers promising overnight riches are essentially the free drinks.
The free drinks and the flashing lights.
Exactly. And the comfortable chairs. They are environmental features designed entirely to keep you sitting at the table feeling excited until the mathematical probabilities inevitably drain your account.
That is a perfect way to look at it. And this behavioral trap leads directly to what we call strategy hopping.
Oh, strategy hopping is the worst.
It is. When a retail trader tries a new tactic and it doesn't make them rich immediately or they suffer 2 consecutive losses, their emotional tolerance just shatters. They abandon the strategy entirely.
They throw it away and go searching for the next shiny indicator on YouTube.
Exactly. Rather than understanding that a back-tested edge requires time to play out, Simon references the CNS curve, which tracks how strategies perform across 3-year market cycles.
CNS stands for consolidation, normalization, and speculation, right?
Correct. A trading strategy optimized for a raging speculative bull market is going to take calculated losses during a boring consolidation phase.
Because the market conditions are completely different.
Right. The professional trader understands this cycle. They know their edge will return, so they stay patient.
While the amateur panics.
The amateur panics, changes their strategy at the exact wrong moment, and slowly bleeds their capital to death.
It brings a lot of clarity to have a framework like Simon's. It actively counters the toxic, adrenaline-fueled culture in the broader crypto space by anchoring you to statistical probability rather than emotional thrills.
It's very grounding.
It is. You realize that you don't have to be sweating over 1-minute charts with maximum leverage to be successful.
But understanding the psychology is only one half of the equation. The other half is how you physically execute that discipline.
Right. How does the Paradise team systemize this patience to protect their own profits from their own human nature?
Well, this might be my favorite insight from the entire analysis.
Oh, the Berkshire Hathaway hard wallet strategy.
Yes. Simon revealed that the Paradise team manages their capital much more like a traditional conservative hedge fund, specifically modeling their philosophy after Warren Buffett's approach.
Which is a comparison that actively defies the standard crypto degen narrative.
Completely defies it. Instead of taking their trading profits and rolling them back into riskier, highly leveraged day trades.
Which is the gambler's instinct to double down,
Yep.
right?
Exactly. Instead of doing that, they systematically siphon their profits completely out of the active trading ecosystem. They move that capital offline into cold storage hard wallets.
And the composition of those hard wallets is the key here. They do not just hold Bitcoin.
No, they aggressively diversify that extracted profit across stablecoins like USDT, physical pegged gold assets, and Bitcoin. They are isolating their wealth from the volatility they trade in.
Okay, I have to push back on this concept a little bit because I can hear the counter-argument forming already from our listeners.
Sure, go for it.
Traditional hedge funds do not just stuff cash under a mattress. They are always seeking yield, right? Staking, lending, earning interest. By pulling capital completely offline into a hard wallet, holding stable coins and gold, aren't you just sitting on dead capital?
It seems like it, yeah.
Right, like in a high-octane environment like crypto, isn't eating the opportunity cost of zero yield completely counterintuitive?
That pushback makes total sense until you factor in counterparty risk.
Ah, counterparty risk.
Yeah. The degen lifestyle is obsessed with squeezing out an extra 5% yield by lending assets to unproven platforms. But the professional trader knows that keeping the money is significantly harder than making the money.
Wow, keeping it is harder than making it. That hits hard.
It's the truth. When you chase yield, you are handing custody of your wealth to someone else. In crypto, platforms collapse, smart contracts get hacked, liquidity pools drain overnight.
We've seen it 100 times.
Exactly. The Paradise team accepts the loss of a small percentage of yield in exchange for absolute mathematical certainty that their capital will be there when the generational buying opportunities arrive.
So they're preserving their ammunition for the true structural market bottoms rather than wasting it on Tuesday afternoon chop.
Precisely. And Simon actually provided the exact target they're waiting for to begin aggressive reaccumulation. He is looking at the 0.618 Fibonacci retracement level.
Which currently sits right around $51,000, right?
Yes, around 51K.
Let's unpack the math behind that. Why the 0.618 Fibonacci level? People draw these golden ratio lines on charts all the time, but why does a 61.8% drop from the local top translate into an actual physical market bottom?
Well, it translates because that specific mathematical threshold perfectly aligns with the operational pain threshold of the market's biggest players.
The miners.
The Bitcoin miners, yes. A major market bottom requires capitulation. It requires an exchange of assets from weak, over-leveraged hands to strong, patient hands.
And a Bitcoin miner isn't just, a person with a graphics card in their basement anymore.
Not at all. These are massive industrial operations with fixed fiat currency overhead.
They have millions of dollars in electricity bills, cooling costs, and real estate leases.
Exactly. So if the price of Bitcoin drops roughly 60% from the highs, their profit margins evaporate entirely. They're suddenly mining at a loss.
And they can't just pause the operation.
No, the bills keep coming. If the market stays at that 0.618 level for long enough, These industrial miners are squeezed to the breaking point. They are forced to liquidate their Bitcoin reserves.
And eventually they're forced to sell off their physical mining rigs just to avoid bankruptcy.
Yes, that intense, desperate, forced selling is true capitulation.
And who is standing there, ready to buy all that heavily discounted Bitcoin from the desperate miners?
Just smart money.
The people who siphoned their profits into a hard wallet 6 months ago sacrificed the tiny yield and just waited patiently with a stack of stablecoins.
The casino owners.
Yeah.
That is how generational wealth is transferred. It requires the emotional discipline to sit on your hands for months, waiting for the market mechanics to bring the absolute highest probability setup right to your doorstep.
You know, everything we have discussed today, the hard wallets, the ABC wave analysis, understanding the liquidation cascades, waiting for the miners to capitulate, it all relies on an underlying psychological framework.
It does. Without the mental code to execute this, the technical data is just useless.
Right. Simon closed his analysis with a 5-part mantra that guides his everyday trading, and it perfectly encapsulates the Paradise team philosophy.
This mantra is the behavioral safety net. It is really worth exploring each pillar.
Let's do it. First rule. Think in probabilities, not emotions. This goes back to fighting the way our brains are wired. Humans hate uncertainty.
We really do. We want guaranteed outcomes.
Right. So thinking in probabilities means accepting that even a perfect setup has a chance of failing, and you cannot take that failure personally.
Rule 2 is the physical manifestation of that. Remain calm and disciplined in every market condition.
Whether the market is experiencing a massive impulse inhale or a brutal zigzag exhale.
Exactly. Your internal resting state cannot fluctuate. The moment your heart rate dictates your trading size, you have lost the edge.
Oof, yeah. The third rule targets the urge to constantly be doing something. Follow the system with precision and patience, waiting only for high probability setups.
It is the understanding that being in cash, doing absolutely nothing, is an active and highly profitable position.
Just waiting on the shore. Followed by rule 4, protect capital above all else. Because if you lose your chips chasing low-probability dopamine hits, you do not have a seat at the table when the capitulation finally happens.
You're just wiped out.
But the 5th rule is the one that really shifts the paradigm for me. Treat losses simply as feedback to sharpen the strategy, and wins as the result of disciplined execution. I want to really dig into this idea of losses are feedback because it requires a massive cognitive reframing.
It is arguably the most difficult skill for a human being to master.
Seriously.
Consider what happens when a retail trader takes a loss. It immediately triggers an emotional cascade, usually anger, fear, or a severely bruised ego.
Their brain literally perceives the loss as a personal attack by the market.
Exactly. And that emotional sting inevitably leads to revenge trading. They jump right back in, usually with higher leverage, trying to aggressively win back what was taken from them.
Which almost always leads to the account getting entirely wiped out in a matter of hours.
Yep. By framing a loss purely as feedback, you neutralize the emotional venom. You completely remove the human bias.
So the loss ceases to be a reflection of your intelligence and simply becomes data.
Just data. It's the market telling you that the macroeconomic conditions have shifted, or that your rigorously back-tested strategy hit a low probability variance. It recenters your mind right back on the math.
And viewing the wins as disciplined execution instead of like, I am a financial genius, is equally important.
It absolutely is.
It prevents that toxic overconfidence that usually precedes a massive loss. You didn't win because you magically outsmarted a global financial market.
No, you won because you rigidly follow the rules of a mathematical system.
Both sides of that rule serve the exact same purpose then, keeping the ego completely detached from the balance of the portfolio.
That's the secret right there,
Yep.
detaching the ego.
It is an incredibly powerful framework. We have covered a tremendous amount of ground today. We started by looking at the terrifying mechanics of the market, watching whales move hundreds of millions of dollars, understanding how the spot market absorbs the messy liquidation cascades of the futures traders.
We examined the physical structure of market movement, how those impulse inhales eventually lead to the complex ABC zigzag exhales that trap so many eager participants.
And from there, we took a deep dive into the psychology of survival. We explored the fundamental behavioral differences between a gambler hoping to hit zero on the roulette wheel and the casino owner who calmly relies on mathematical edge over time.
Yeah, And we saw how the Paradise team physically protects their wealth through the Berkshire Hathaway hard wallet strategy.
Accepting zero yield in exchange for the absolute security needed to capitalize on the capitulation of massive industrial miners.
It is a comprehensive blueprint for outlasting the 96% of participants who just fall victim to their own emotional wiring.
It truly is. As we wrap up this deep dive, I want to leave you with a final thought to ponder on your own. We spent a lot of time breaking down Simon's final rule, treating losses as feedback and wins as disciplined execution.
Such a vital rule.
It is. And if that specific cognitive reframing can completely rewrite your success, survival, and stress levels in a hyper-volatile crypto market, well, how might adopting that exact same casino owner mindset change the way you handle the unexpected risks, the daily setbacks, and the lucky breaks in your own life entirely outside of trading?
The principles of emotional regulation, patience, and probabilistic thinking are universal. The market is really just an accelerated mirror of human nature.
So the next time you see a massive splash in the water, a terrifying red candle on the charts, or a whale moving millions in an instant, remember, you do not have to panic, and you do not have to be the prey.
No, you can be the one patiently waiting on the shore.
System in hand, completely removed from the chaos. We warmly thank you for joining the MyCryptoParadise family for this analysis. Keep your capital safe, stay fiercely disciplined, and stay focused on the probabilities until next time.